Here's a hard truth. The reason you're struggling to keep up financially might have less to do with you and more to do with the interest rate the banks are setting. What is interest rate? Let's start off with what interest rates are. In essence, interest rates are the costs of borrowing money, or the reward for saying it. In other words, interest rates can be defined as the price a person pays when they borrow money, or the return they get for lending it. You may find that it is expressed as a percentage of the principal sum that is borrowed, be it the original amount of the loan that a person may borrow from a financial institution, or the deposit the same individual may drop when they acquire a home or a vehicle, for example. Another instance where interest rates may apply is when you save money in a high-interest bank account. That interest rate may determine the extra or bonus money the account owner may get coming to their savings. How do banks set interest rates? Simply put, the central bank of any given country is the body that is responsible for determining and influencing the country's interest rates. In the U.S., for example, although there is no central bank per se, the Federal Reserve is the body that is in charge of setting the interest rate at which commercial banks are allowed to conduct their lending business. In order to implement changes on its policy rate, the central banks of these countries conduct open market operations. This means that they periodically buy or sell government securities on the open market. That way they can either lower the interest rates or raise them. In order to lower the interest rates, you may find that the central bank would buy some of the aforementioned government securities from banks. In return, a ton of money will be injected into the banking system of the country. As a result, you'd find that the supply of credit will increase. It will also have an effect of reducing the interest rates that the banks charge at that time. As time goes on, you'd find that the consumers and the businesses they run will eventually feel the effect of the lower interest rate. Such moves may prove to improve the state of the economy, as people may feel more encouraged to partake in more business activities. On the other hand, you may find that the central bank may sell the same government securities to the banks so that they can increase or raise the rates. This understandably has the effect of removing money from the banking system. That way, there will also be a reduction in the supply of credit, thereby curbing the amount of loans given to the members of the public. After all, the rise in the interest rate would make it a lot more expensive to take those loans from the banking institutions. Why do central banks change interest rates? Looking at how it seems simple enough for these central banks to manipulate the amount of money circulating in the banking system of a country, it may make you wonder why they may even want to either lower or raise the interest rates of a country. Why is it so important for them to monitor the rate at which business is being conducted by the banking system? Well, you'll find that there are several reasons for this to happen. Controlling inflation. For starters, you may find that the most common reason for manipulating rates in a country is so that they can control the rate of inflation. Once a country notices that prices are going up a bit too quickly to be sustainable, the central bank may take measures to increase the interest rates. That way, the citizens may feel compelled to hold on to their savings, especially when they notice that borrowing money is too expensive for their tastes. In the end, this could have the desired effect of consumer spending and investment in different types of business. In time, you'd find that this could heal the economy, if you will, by bringing inflation down, triggering economic growth. Aside from controlling the rotation of inflation in a country, you may find that a central bank of the same country may decide to manipulate the rates so that they could stimulate the growth of their economy. As we may have hinted at earlier on, the central bank may reduce the interest rates so that there could be more economic activity. If they notice that the economy is slowing down or that the rate of unemployment is on the rise, the reduction of the rates could encourage more people to take more loans so that they could invest in lucrative projects. On a consumer level, it could also allow said consumers to make bigger purchases, thereby boosting the spending en masse. In the end, this could prove to trigger the much-needed boost the economy may need at that point in time. Reasons to care about the interest rates. In the end, it may benefit people more to pay attention to the interest rate in their country at any given point in time, because for starters, it will help you make informed decisions on the loans you take and on the savings you keep during such a period. As such, you can either head out to buy that dream home of yours, or you could properly plan out how you are going to maintain your budget. During such a period, you'd also find that keeping an eye on the interest rate could help you make that dream investment to your stock portfolio or that piece of land that you've been eyeing for some time now. At least now that you understand how interest rates work, at least you can say that you can now understand how interest rates matter. Money shouldn't be confusing. Subscribe now and I'll keep making it simple.